Hey, everybody. Thanks for tuning in to the Rent to Retirement podcast. In today's episode, we talk with top-ranked residential mortgage lender Graham Parham, who's been a mortgage loan officer for over 21 years. Graham works with Highlands Residential Mortgage in Dallas, Texas, and is in the top 1% of mortgage lenders in the U.S. As an active investor himself and investment property specialist, Graham has a strong feel for what makes investors accomplish their goals, both short-term and long-term. We hope you enjoy this interview. And without further ado, I'd like to introduce you all to Graham Parham.
Thank you. It's a pleasure being here.
All right. Well, as you know, you've financed many properties for our investors over the years. You are our top recommendation for our investors because, well, one, you're a professional investor yourself. And I think that's an essential piece. We always talk about with our investors, you're building a network and a team, and that's vital to your success long-term in building a rental portfolio and a rental business. You need to have the right team members built, and having an essential lender is a part of that team. And so we appreciate you taking out some time and joining us to kind of go through. We want to do an introduction just to about financing an investment property in general, what that means, what is a part of that, and kind of how that ties into a strategy long-term. So let's go ahead and start to just talk a little bit more about you, if you don't mind just giving us a quick background about yourself and what got you into the mortgage industry in the first place and investing in real estate.
Well, I was in corporate America there for about 15 years and tired of jumping planes. So I decided to go peddle some loans. And like most loan officers, they start off doing the primary residence gig. And then somehow back in, I guess it was like 98, 99, I started getting involved with some investors. And this industry, I don't need to tell you, Zach, is very small and the word travels pretty quick. And so I started gaining a lot of momentum in the investment category. And then I start seeing all these tax returns coming across my desk. So I jumped in about 16 years ago and drank my first Kool-Aid then. And it's been great ever since. So yeah, it helps me my job, dealing with people that we deal with on a daily basis. And they're mainly put them into the newbie categories because mainly they're just getting started off growing their portfolio. You've done an excellent job of teeing them up and what their expectations are. And then of course I step in and talk about the financing piece. It just helps them understand a little bit more of what we do as a lender because they respect the fact that I do have skin in the game. And, I'm going to provide two hats, one as a loan officer, another one as an investor. And as an investor, I can only give them my opinion. And I've always said, many times over, the smartest people can make the dumbest mistakes, and I'm one of them. And if my job is to grow and help them grow their portfolio and keep them on the right path so they don't get snake bit, I've done my job.
I love that. Yeah, you brought up a key point. Well, that's a big reason why people come to invest in the turnkey route in the first place is the simple fact they're looking for some guidance and mentorship from all sorts of different professionals like yourself on the financing side. And, you don't have to go out and make the same mistakes that everyone else makes. That can be very time intensive, very costly. If you just have a little bit of guidance on the, along the way, and having the right financing options is vitally important. So I like that you brought up that point.
Yeah, Graham. So we understand, you're an investor yourself. And that I heard on another piece of media, another interview, that you bought some turnkey properties from providers, around the country. And I was curious why you went the turnkey route yourself, and then also who lends to you if you're a lender yourself?
First of all, I got a full-time job. I don't have time to get out on MLS. I don't have time to find a contractor, a management company. I don't have time to do any of that. I don't want to. I don't have the patience for it. I tried it 16 years ago. I tried to self-manage one in my backyard. When I was in front of a judge and he was laughing at me, telling me to get me out of the court because I didn't know what I was doing. I knew right then and there I didn't want to manage. So I want to be a landlord, not I want to be an investor, not a landlord. And so that's why the turnkey model makes a lot of sense because they do it turnkey, soup to nuts. And the way I look at it when I buy my properties, you send me the pro forma, some pictures. I get on Google Earth and Google Maps and look around at the neighborhood. I make a decision. It's not that hard. A lot of people want to get analysis paralysis and don't get all these spreadsheets and all this other stuff and trying to come up with the return on investment, the cap rates and all this other stuff. I just look at it and go, how much is my price? What's my rent? What's my cash flow? And I'm good with that. So I was doing my loans up until a couple of years ago. I'm fannied out, so to speak. My model is working with investors that are just getting started off and encouraging them to use the quote golden ticket 10, which we can go all the way up to 10 loans for them in the Fannie world. And the Fannie Freddie world is still your optimal prices and optimal terms. When the mortgage meltdown, not meltdown, but more of the mortgage liquidity problem started back in March, April, everybody other than Fannie Freddie left the playing field. You know, the Alt-A lenders, the non-recourse, the commercial, everybody left the playing field but Fannie Freddie. So we hung in there because the government allowed us to, and they're still buying a lot of mortgage-backed securities to keep this afloat, which is great. Rates are down and dirty and so forth. But to answer your question, I'm outside the Fannie box. I have to use a portfolio or non-recourse lender, but it's not that bad. There is life after Fannie. I mean, I'm closing on, like 4 3/4 rate on a 30-year fixed. It's not that bad. I was locking loans a year and a half ago at those rates. So it's not that bad, but the Fannie world, we're a lot more aggressive on the rates and terms. So, take advantage of your 10 while you have them.
That's fantastic, Graham. You brought up a lot of good points I want to just revisit real quick. I think to the first question Sam had about investing in turnkey, it's so crucial that, you really broke down the point that you're a lender, you have a profession, you don't want to be a professional landlord. And that just takes a lot of time and energy and risk, and really dollar per hour, your time is better spent working in your active profession. So that's why it fits for you. And that's why it makes sense over time. Just by owning property, you can get in and dive in and do the analysis on everything. But the big picture is just simply owning property over time, from the appreciation, the debt pay down, the tax benefits and depreciation. Sam just did a video about hedging inflation risk with using debt and leverage. I mean, that all compounds over time. That's huge. I want to get in, kind of make the transition next into talking about what qualifies a person for a conventional loan. Why are they going conventional? You kind of hit on that already. And what are the limitations? That's a question we get a lot initially is, what sort of lending are my options and which route do we want to go? We always tell them, like you said, the golden 10, that golden ticket is their conventional Fannie Mae Freddie Mac loan, which you mentioned they can have up to 10 under their own name at any given point in time. If it's like a partnership or husband wife team, in theory, they could each have 10. Is that correct? If they each individually
qualify? Those have changed kind of over the years, off and on. How do you count against the spouse? How do you don't count against the spouse? And today, what it is that a lot of partners, as you say, not only life partners, but business partners, 2 or 3 guys get together, want to pull their money together. And we'll talk about that in a moment about the assets. But, if let's say there's 3 partners. Well, I try and encourage, if they all have a good paying job, why don't you go get 5, you go get 5, and so forth. And let's just, start building that inventory. And eventually down the road, they'll kind of join that ownership into some kind of an entity, if you will. As far as the qualifying, like on the husband and wife, and I get this a lot. First thing I ask is, does the wife work? Yes, she does. Well, the husband can go ahead and do the loan strictly in his name, but to make the wife happy, we can put her on title. Now, her being on title does not take her away from one of the golden tickets because she's not a guarantor of the loan, okay? He is. Same way, vice versa, and with the partnership. Now, what I've seen happen a lot with people that, let's say they're growing their portfolio to 10 or 15, they'll go out and get a commercial loan and they'll pull it together and they think they're getting it into an LLC loan. Well, a lot of these lenders that are not full recourse or non-recourse, they're partial recourse or still full recourse, even though it's in the LLC name, the individual's still the guarantor, so that doesn't take you out of those slots. And I see that happen a lot too. So if you got some seasoned guys out there thinking that's what you're going to do, make sure that lender does not have you personally as a guarantor, okay? When we do a loan, we look at 3 categories. We look at your credit, how much money you make, how much money you have. Okay, it's really that simple. We get an application online, we take a snapshot of the credit, and we ask you for those documents to support your earnings and assets like tax returns and bank statements. That all takes a couple, 3 days to take a look at, and if the numbers will line up, we're good. So it's really a mathematical process. We take a look at your gross monthly income, and then we take a look at your minimum required liabilities per month, credit cards, car payment, house payment, and we do simple division. And that comes up with a thing called a ratio, or a debt to income ratio. And as long as those back end ratios are still under 50, then we're good to go. It's all math. A lot of lenders will stop at 43, 45. Just depends. They still have a lot of overlays, but we're straight up Fannie Mae. And that's their guidelines. You cap at 50. You can't go 50.01. It just won't work because once we get your data, we upload it into the Fannie Mae engine in the sky. It's the underwriting engine, and we get an answer within a matter of seconds. And it comes back and says, this borrower is approved eligible, which we're good to go, or it's approved ineligible, and here's why. Okay, ratios are too high. There's a lot of different ways that they do that. And if we get an approved eligible from Fannie Mae, we're good to go. That's basically it. We just got to fill what the Fannie Mae requirements say. Okay, give me a pay stub, give me a bank statement, give me all that. We fulfill that as the originators. We fund the loan and then we deliver it.
That's great. So just to use a numeric example, let's say someone has an income of $4,000 per month. They would need to have their expense ratio, for rents or debts and things like that, be $2,000 or less on a monthly basis to be below that 50% DTI, correct?
Theoretically, yes.
2 criteria to qualify, which would be your credit score. Is there a minimum credit score that someone needs to qualify?
There is. We go as low as 620. A lot of lenders will stop at 660, 680. Your rate starts to get a little bit challenged when you get to 620, but we can still do it. We can do a minimum of 20% down, all the way up to 10 loans. Now, the credit score requirements for loans 7 to 10 does have to be 720 or higher. So we can do 620 all the way up to 6. Then 7 to 10 does have to be 720 or higher. That is a hard stop.
A lot of people think it's 25% down. On single family, you can have up to 10 with 20% down.
Correct.
Family, it automatically is 25%, including a duplex, correct?
No, the 2 to 4 units is 25% across the board. Okay, it's mandatory. But those single families, we can do 20% all the way up to 10.
So you can have 10 single family, 20% down on each one of those. Previously in the past, there was a scenario, I don't know if this is still available, where someone could, in theory, get into a rental property with, say, 15% down and pay, PMI. Is that even something that's even on the table anymore or completely gone?
The guidelines are still there for Fannie, but there's no PMI companies that are supporting the investment properties right now since the March, liquidity problem. I don't know when they're coming back into play. There was only really 2 of them that were doing the PMIs for investment properties. When our numbers on those things, the savings, you get a little bit higher interest rate, the PMI payment, really the 5% is not even worth it, to be honest with you.
Just on the higher end of the credit score, I always look at credit as a tool. You got to use it, you know what I mean? And there is diminishing returns if some people want to have this idea in their head of having this perfect credit score, this like 850, credit score, and they don't want anything to mess that up. Is it accurate that there is a point where it cuts off? Is that like 740, 760, where there's no added benefit to have an increased credit score to get a lower interest rate, or how does that work?
In the Fannie world, it's 740. In the world that I live in the non-recourse, I think 760 would be it, but the Fannie Mae world is 740. And then we price in a 20-point increments, 740, 720, 720, 700. When you fall below the 700 mark is when they start to tear you up a little bit on the interest rate. Tear you up, you just probably end up having to pay points, where we try to do it without points.
Yeah, I think the take-home message is it's a necessity to pull the credit. You have to do it.
Right.
There's no way around it. Or if you want to invest, you got to do it. It's not going to have a huge impact on an inquiry. You have a 4-month period to go out and use it and invest in a property. That's more than enough time to find and close on a property. And it's really going to have a minimal effect on your credit overall. That is short term. Your credit will go back up. But the big point is that, most of our investors, their credit score is high 700s, 800s. A credit inquiry is not going to bring them down below that 740 mark.
No.
May or may not even be an effect on the interest rate. Last thing to cover just on qualification criteria is income. It's an easy scenario if you're a W-2 employee. You don't have to have a long work history. You just need 2 previous pay stubs, I believe. You can correct me if I'm wrong. If you're employed, now we're talking about 2 years of tax returns. Can we just dive into that?
When you're self-employed, we take a look at the last 2 years and we do an average. If you had, say, did 100,000 in 18, 150 in 19, then your income's 125. So that's the number we use. And what's odd, if you did 150 and 18 and 119, we actually take 19 in that average. Okay, so keep that in mind. people do have a tendency to take advantage of the tax deductibility, and they'll write off as much as they possibly can. That's why a lot of times people say, well, from a high level, can you give me a pre-approval here? No, because you never know what's going to happen. A good example is, I had a guy the other day, he was a W-2 employee. He worked for Intuit, made $150,000 a year, good to go. Got the tax return. Well, him and his wife decided to invest in this, whatever he invested in. They took a $300,000 loss that first year. That knocked him right out. So the true tale is when I look at that tax return to make sure there's not these crazy deductions that come out of nowhere. But that's how we do the self-employed people. Now, the other thing that started this year, or should I say last year since the COVID, we would never really get a P&L. We just take the last 2 years of the tax returns, do the mathematical formula. Since probably May of last year till now, for any self-employed people, we do now have to have the profit loss statement of your business up to date. In other words, if they haven't done 2020 tax returns, I'll need a complete 2020 P&L as well as any P&L for this year. Reason being is because most of self-employed people, let's just say the people that mom and pop, they had a retail store that was hit from COVID. Well, we just want to make sure that business is still solid, still going. So we do take the additional checks on that. But other than that, we treat them all the same.
And that can be self-reported, right? Your P&L, your year-to-date income. I mean, that's basically just showing that you're still solvent and have income. So self-employment, 2 years of tax returns to qualify, and W-2 is pretty much just making sure you're meeting the DTI requirements. Is it as simple as that?
Correct.
Okay. Is there any way to do less than 2 years on tax returns? If someone's working, as you know, I used to be an optometrist and be subcontracted, work as a 1099 kind of self-employed individual. And so, I know that there was at some point a situation where if you were in the same industry and I went from like being W-2 to being 1099, that since I was in the same industry, they were able to qualify me for a loan before 2 years of tax returns. Is there any situations like that?
Yeah, and it's not where something that's written down. I can tell you where is it 14 months, is it 10 months, is it however many? Remember we were talking earlier about when we get all the data and we put it in and we upload it into the underwriting engine to the sky, which is called the desktop underwriting from Fannie Mae. They're the ones that are going to make that decision. It's going to come back and say, okay, we like the borrower. We only need 1 year's worth of taxes, okay? So let's say they're 14 months into it, but they got the 2020 taxes done, then we're good. It's a case by case, okay? I can't guarantee it every time. Once again, 2 years is your best minimum.
Another question I had for you is, what is important to consider when looking for a good lender, and what questions should investors ask lenders before picking someone to work with?
Well, they are two types of lenders, or three types of lenders. You got your big banks, okay? And of course, I try to tell everybody to stay away from them because they've lost sight of the customer years ago after the meltdown. They're more concerned about the stockholder than they are the consumer. And you can tell that they're front-end customer service. It's just they just don't have it. They don't have the quality of people to provide that kind of service where your customers expect that, okay? Being a seasoned employee or seasoned landlord, as well as a seasoned loan officer in this business, all I do is invest in properties. Well, I think I kind of know what I'm doing, okay? So that's one thing. Then you have a mortgage banker, which is what I am. We do everything in-house. We process, underwrite, close the loan, even post-close. We service the loan. Everybody sells the notes off when they close it, even the big banks, but most of them keep the servicing, whereas we do the same thing. Only difference is we're not a depository, okay? And then you have your broker. And the broker's the guy that can virtually work out of the trunk of his car. And he has to send documents across town or out of state to have somebody else process and underwrite that, which could be very time consuming depending on where he sends it. What I do, and not being in a big bank, because that's the conveyor belt syndrome, I have my own team. Okay, I've got 12 people on my team and they focus strictly on my loans. So we have a kind of a well-oiled process, if you will. Once we get the documents, we have the next step, we order the appraisal, so forth and so on. So we understand the nature of the beast, how to get these things done. And we keep you informed every step of the way. Zach, you've seen those emails, the touch emails that we send out to the customers as yourself, kind of a milestone, if you will. A lot of times other lenders just don't do that. So we keep you well informed. Everything else is, basically says, okay, when I tell them I'm an investor, I usually capture 50% of the option, right, of the crowd right there immediately. Oh, that's so good. And it does help. But doing this length of time also helps. And if they want to go out and look around, they're welcome to do so. And a lot of them, you're going to have your price shoppers. Fortunately, I think our price is very much in line, if not very, very competitive. But I'm not going to capture everybody. They have to make their decision. They have to feel comfortable who they're working with. They may not like me. They may wish I had that beard on, but, it just is what it is. But I think my capture rate's pretty high.